Okay, everybody, I think we're going to go ahead and get started now because we've got several people here logging in as we go. Um, this is our halftime report, and we like to do this roughly about the middle of the year. I know it's September 1st as of today, so that is not exactly the midway point in the year, but it takes us, a couple of months to get all this data together and put these presentations together and have to go through compliance, and it's a lot of rigmarole. So here is some formalities just to familiarize yourself with the securities industry, and we're not providing any legal advice or tax advice or anything like that here. Merely market commentary. And as always, we welcome your questions. I think there is a way at the very bottom there for you to enter some questions or write them in, raise your hand, something like that. And so what I'll do is if you have any questions, write those in there, and at the end, I'll come to them. It's not like classroom style where you can just, raise a hand and then, have that banter back and forth, which is what I much prefer. But, for those of you who are not necessarily right here in Atlanta, this is the next best thing. So I appreciate you tuning in. And I do appreciate questions because if you have a question, chances are someone else is thinking the same thing too. Today's agenda, we're going to talk about obviously what happened in the first half of the year with the markets and what we're looking at in terms of the second year of the markets and kind of where we are now economically, and what's ahead for the second half of the rest of the year. And I just want everybody to know that I'm not a Republican, I'm not a Democrat, I'm sort of anti-political. I'm just an economist, and so I place a lot of blame, but I want you to know the blame is equally spread. So I hope I don't offend anybody. So what happened in the U.S. markets? 2002 was not such a great year. We were down about 20% across the board. NASDAQ was down a good bit more. And but for so far this year, 2023, it's been pretty good. You may remember back in March where we had some bank failures. People may not know this, but the top five, or let's just say four of the largest bank failures in U.S. history occurred this year. So the largest of all time was in 2008, which was Washington Mutual Bank. But then First Republic Bank, Silicon Valley Bank, and Signature Bank all filed bankruptcy, or at least went under and had to be taken over by the FDIC. That was this year. So problem with that is that as interest rates have gone up, a lot of their holdings were treasuries and other bonds that lost a lot of value as interest rates went up, because interest rates and bond prices work in an opposite direction. So yields go up, bond prices drop, and their assets, if you will, took a big hit. And so I don't know if it's good news or bad news, but the news is that the FDIC has opened up their coverage to an unlimited amount. So you may remember it was 250,000 per account, and then before that it was 100,000. Well, now it's unlimited. So that's the good news. The bad news is that those three or four banks are probably not the last banks that we're going to see that have to plug into the FDIC insurance, and so it's just a matter of how much can we bail it out. But we're talking about trillions of dollars in terms of if the FDIC has to bail out everybody. So that's problematic. And of course, we don't have the money. So the way around that is we just create it, out of nothing. But so far, so good this year. The market's been back up. But as I'll show you in a second, there's some ominous signs looming. Now, one of the things that we do is we look at what other major firms are suggesting, what their economists are suggesting in terms of, what would be the forecast on 2003. And so everybody here sort of averaged out about 3,800. That's on the S&P 500. So, already at May 31st this year, we're at 4,100. And today, let's see where we are on the S&P. We're at 4,500. So we really blew all of those averages away so far this year. And it might be a good time to get out, as you see, as I show you in a second. We definitely are on the safer side of investing these days. So let's just see what market forces are happening behind the scenes. We know that it's been good years so far, but can we continue to expect this to could finish up the year. Now, this is January of 2022, so about a year and a half ago. This is when COVID was behind us, and we all were starting to go out to eat again and work again. So the economy was doing much, much better. And you can see that there's a lot of green here. Monetary policy was green. Consumer sentiment was green. I'll talk more about that later. Consumer spending was high, because remember, consumer spending is very, very important for our economy. Fiscal policy was good. Interest rates were low. Energy costs were low. Credit availability, there was plenty of credit available, and there really wasn't a whole lot of, what we would call frontline inflation. So everything was looking really good. Then if we fast forward now, just 1 year later, you can see that everything has changed. The yield curve is inverted, mainly because interest rates are up. Monetary policy is going in a monetary contraction phase. So remember, when we have monetary expansion, low interest rates, and stimulus, stocks usually go up. When we have a contraction phase, high rates, and unwinding the stimulus by letting bonds mature, treasuries mature, and we don't refund those treasuries, because remember, the treasuries were bought by the Fed with money that the Fed just created. And that causes inflation, just textbook. But now when they unwind that, we have the opposite effect, which is a good thing. We need to have deflation, but that causes a credit crunch at some point. And that's why we see, lending indices were down. Mortgages are down. Obviously, interest rates are higher. If you go look at a mortgage rate right now, you're looking at around 8%. That's drastically different than what we're used to. So we're going to talk more about interest rates in just a second, but you can see that from the first year, January 22 to January 23, significant deterioration. And then moving on now to June of this year, it's deteriorated even more. And this is to be expected, really, with drastically rising interest rates, aggressively rising interest rates. It's not as bad as it was in the late 70s and 80s. But in terms of the change from where we were to where we are now, significant difference. So we can see monetary policy is in the red. Yield curve is still inverted. So that's always a sign of danger. But you can imagine, because if you think of it in terms of CDs, if you want to buy a 10-year CD or a 5-year CD or 6-month CD, interest rates are going up. Why do you want to lock in on a long-term rate or a long-term CD, right? You would go to the short term. Well, in a position where yield curves are inverted, that's exactly what you do. So right now, for us and our clients, we're all stacked up in 2-month treasury notes, bills. So these bills are coming, or the notes. So T-bills are coming due every 2 months, and then we just reinvest them in the next series, and every 2 months they're maturing. And at some point here, we're going to go out in a longer term when we think that the Fed is done raising rates. But that's anybody's guess right now. If we look at inflation over the last few years or year over year, it has come down. That's the CPI. That's the number that we get from the Bureau of Labor and Statistics, not always the most trustworthy source. They've changed the CPI formula twice over the last few years. They changed it once in 1980 and then again in 1990. And so if we go back to the 1980 formula, the 1990 formula, inflation really is much, much more like what you would see at the grocery store. So for those of us who actually go and buy our own groceries, you can see that inflation has cut pretty severely. But officially, it's down from where it was. But Powell was very, very adamant about getting us down to 2%, and we're still at 4.9. So they're meeting later this month, the 20th and the 21st of this month, and we'll see what they're going to do. I guess the market is expecting them to hold rates. So we were sort of expecting them to raise rates, but we can see now that maybe they will hold rates because of the unemployment. Unemployment is a little bit higher than they expected. So speaking of the labor market, unemployment, was very peaked right out there when we had the COVID lockdowns. But then if you look now, our current job openings are pretty significant, and unemployment is much lower than it was. So it's down below 4% now for official numbers. So there's a lot of job openings. You probably may have been out to a restaurant or something and they had a whole section cut off or it's closed off because they didn't have enough wait staff that day. Or I've been to where the restaurant was completely closed because they just didn't have people that they didn't come in, or they just don't have enough people to run the show. So definitely some job openings out there, even though we see big companies cutting, jobs left and right. Amazon and Facebook and all those guys have let thousands of people go. So everybody kind of sees this coming. It's not going to be a surprise, I don't think, to a lot of people, but it seems like half the people out there are just throwing money into the market. And that always happens too, because these people have the fear of missing out. And so they see the market going up and they're afraid they're going to miss out on that. And it's going to go higher and higher and higher, and really just throwing money into a real tenuous place. So one of the ways that we can kind of see lagging effects, but also positive future effects, not positive or negative, but in this case is consumer sentiment. So that's just how people are feeling about spending money mainly, or how do they feel about the economy. And they get this from calling 100 people. I guess they do it weekly, and this is through the University of Michigan. So they ask all this series of questions, but you can see consumer sentiment is very, very low. Lowest has been since really 1979 in that area. So even lower than it was during the 2008 era. So the problem with bad consumer sentiment is that people don't necessarily spend as much money as they used to. They don't play golf as much as they used to. They don't go out into the malls and buy things as much as they used to. So in the light of higher interest rates and negative consumer sentiment, generally what you're going to have is lower sales and lower profits. And we already see that in terms of corporate earnings, because remember, 2/3 of our economy is our consumer spending. And we do a really good job at it. But when we get nervous and we have negative consumer sentiment, then we spend less, as a nation, and we go out to eat less, and we party less, take fewer cruises, take fewer trips. And what that does is just reduce corporate earnings. So when you have lower corporate earnings, you have less demand for that particular share or that particular stock, and then generally the price will drop. And so that's why another reason that we can see these headwinds coming, because interest rates are going up, home sales are dropping. There's no real reason to refinance right now. Most of the people who have a mortgage have a low rate, but people who are now looking to buy a new home are facing rates of 8% or more. And that's what you've got good credit. So what I want to do, though, is talk about the longer term effects of how interest rates, work in our economy. And I know that I've had clients with me forever. I know some of you have heard this many times before. Charles, I know you've heard it 1,000 times. I know you're probably sick of it. I apologize. But some of you may be new to you, or maybe you just need a refresher. Now, what we're looking at here is the Fed funds effective rate, okay? And this is the rate that those guys get together and sort of vote on every couple of months. And they've been raising this rate. Now, this is the short-term rate, the rate the banks lend money to overnight, okay? But it's the rate that sort of all the other rates are based on. But the short-term rates are fixed based on what these guys decide to do. And what I want to show you there, as you can see, the blue line are the interest rates, the gray lines that are running vertically. Hopefully you can see that. Those gray lines represent recessions. Okay, so what I want to draw to your attention is that oftentimes there's a rise in the blue line, which is interest rates, and then you'll have a gray line, which is a recession, and then you'll have a significant reversal, and then a rise in rates again, gray line, recession, reversal, and that kind of goes on and on and on and on, and it continues to happen. The gray lines of recessions, that's 20 months of back-to-back negative GDP. So there's times in here where we had market crashes, okay, but we didn't necessarily have a recession like in 1987 here. But that doesn't mean we didn't lose a lot of money in the stock market, because people did. So what we want to pay attention to here is the fact that when they raise rates, they kind of keep raising them. They don't know when to stop. And then, that's what they call a soft landing. Well, there are no soft landings. They've all been hard landings. They've been crashes. And so the question is, what's going to happen next? Are they going to all of a sudden now get it right? Or are we just going to, is it just going to be business as usual where they don't predict the future like no one can? And then all of a sudden, we're right back to where we started, which is with another recession, another crash, lower rates back down, and more stimulus. And here we go again. That's my vote. And if you disagree with me, let me know, because if we're managing your money, you're the boss. We're just doing our best to protect it right now. And I think if you see these charts, you have to say, yeah, Kevin, this is the time to protect it, because it definitely looks suspicious. And what I want to do is I want to go all the way back to the 2008 debacle. So this is the NASDAQ from 2005, the work up to that, to 2009. Now, I want to show you what the Fed was doing during exactly the same period of time. Okay, so the same period of time, they were raising rates. Here they are, it's pretty aggressive, quarter of a point almost every time they met. And then what happened there was there was a drop. There was a drop in 2006, and that was in the summer of 2006, July and August of 2006. There was a big drop, and so the Fed responded by just pausing. They stopped raising rates and they just paused. Okay, we're not there yet. They're still raising rates where we are today. Okay, but they paused. Now notice that they didn't drop rates after that initial drop. They just kept the rates where they were, and the market kind of recovered, and it did well between that time and then where if things finally capitulated. So what I want to point out here is that at this rate, the Fed didn't increase rates anymore. They just paused. They held rates where they were, but it didn't matter because at that point the market collapsed. Okay, so you can see that even though they kept rates flat, it peaked out, and then the market collapsed after that, and there was a 50% loss. Okay, so we went from 2,800 to 1,400. That's 50%. Okay, so a lot of growth throwing up here, but after this started getting very, very dangerous. Now I'm pointing that out because it's very close to where we are today. If we look at the NASDAQ for the last 5 years, here's obviously where we had our the COVID crash, I call it. So the COVID crash, and then remember what happened after that. We had a whole bunch of stimulus. We had PPP. We had people getting money for free. I'm not even really sure what all the programs were, but there was a lot of money that was created, a lot of money that went out into the system, and the NASDAQ just took off like crazy. Then you can see that after 2021 or 2022, the January 2022, there was a big sell-off in the NASDAQ during that period of time. Since then, we've come back a good bit, maybe half the way. So we're at about 14,000 on the NASDAQ. But what I want to point out here again is the differences in where rates were then and where rates are today, and what the Fed did then and what they're doing now. So back when we had that massive growth from the COVID crash, here it is right here. And again, these are the Fed funds rate, the same thing we were looking at, just focusing in on the last 5 years. You can see that, okay, we were on the way to raising rates, and then they plateaued, and then we had COVID, and then they had to drop them back down, and then we had a whole bunch of stimulus, which was like just gangbusters for the market. And so the market went way up. Well, not just the market, also prices. So inflation is rampant through the country. And if you go to the grocery store, you can see that for yourself. Compared to the prices of things that you see in the grocery store today to when you were a kid, or even just 20 years ago. So you can see there's a big difference. Now, what we're facing again today is the same thing that we were facing back then in 2007, and that's these aggressive hikes. But these hikes are even steeper than the ones that were happening in 2006 and 2007. So here we are. And if we go back and take another look at the longer period of time, we're basically back to the rate that we were even before 2008, all the way back to 2021. So rates have not been this high since in 22 years. So you see what happens every time they raise these rates. You see that there's a recession that follows it most of the time. And if it's not a full-blown recession, it's a market drop. It's a market correction, crash, whatever you like to call it. Usually there's a 30 to 35% sell-off in the Dow, the S&P, and the NASDAQ sometimes has a 50% sell-off, as we saw in 2008. I can't say that that's exactly what's going to happen this time, but something similar, certainly. You can see where the rates are back to where they were at that same time, And in my opinion, it's just a matter of time before things lock up. We call a credit event, where there's just no more credit available, and market starts selling off. This has been happening since the 1600s. So the problem is it's been exacerbated in the last 100 years because of the Federal Reserve and their ability to manipulate these interest rates, when really interest rates should be set by supply and demand. That's just the natural order of things. And when you have short-term interest rates that are paying more than long-term rates, that's abnormal and doesn't happen in the natural world. Okay, so if we look at kind of the elephant in the room now, and we talked about rates and where they're going kind of in the short term, we have to kind of look at our country in terms of the long term. And the real problem, besides just the short term manipulation of the rates, is the debt. And I don't think that's a surprise to anybody. I mean, I remember being here just not too long ago, and we were at 20 trillion, and now we're at 32 trillion and counting. And now interest rates go up, so there's higher interest on the money that we already owe, but we don't have the money to pay that down, so we have to borrow more money to pay the interest, and that just gets tapped on, stuck right on top of the debt. And you can see our debt is almost going vertical now. So if you're a person living at home, you're trying to balance your own budget, balance your own life, this is not a good example. This is not a good example of good fiscal policy, good monetary policy. So we have really, really screwed ourselves over, so to speak. And we had a great thing going. We had a great thing going because we were, and still are, but barely, the world's reserve currency. And what that means is, basically, when countries want to do business with each other, they have to go through the dollar to have that business occur. And that's the reserve currency. So everybody keeps dollars on hand. They all keep dollars in reserve. And what that means for us is we have the ability to create dollars from nothing and basically sell them to everybody. I mean, that's a great position to be in, is it not? But now people have caught on to that. And it's not necessarily a friendly thing to do to undermine someone else's economy, intentionally or non-intentionally. So what it's caused other countries to do is to look at alternatives to the US dollar. And this has really picked up in the last year or so. In fact, just last week, the BRICS met in South Africa. And the BRICS stands for Brazil, Russia, India, China, and what's the S? South Africa. There you go. So those are the BRICS, and they just had a meeting, and already they've had several countries that have joined on with them. They will be coming online in 2024, 2025. Argentina, Egypt, Ethiopia, Iran, but importantly, Saudi Arabia. So right now, everybody complains about petrodollars, which means if China wants to buy oil from Saudi Arabia, they've got to convert their yuan into dollars and then pay the Saudis. Well, if the Saudis have exactly the same currency as the Chinese and the Russians and the Indians and the Brazilians and South Africa and now Argentina, Egypt, Ethiopia, Iran, and the Arab Emirates, that's more than 50% of the population on the planet. Okay, and then all of a sudden now the dollar's left out in the cold, and these people don't want to keep dollars anymore, so they dump them. And other people don't want dollars because they can deal in this. And here's the thing: these BRICS, this currency is supposed to be gold backed. All right, our dollar is not backed by anything except for their taxation ability, which they do a lot of. Right, they're good at that. But in terms of this currency, if it's a gold backed currency, that really answers a lot of the problems with inflation, because it keeps everybody tied to gold, as we used to be before 1971. So that being said, there now is going to be a serious competitor to the dollar. But, China and India are squabbling, and Russia's in a kind of a negative place, and Brazil just doesn't really have much of an economy, neither does South Africa. So they all have their own problems, and they're not getting along the best, and we'll just have to see how that works. I know that Brazil and Argentina don't like each other in terms of when they're playing the World Cup, but I think they're good neighbors now, so that's good. So we'll see. I think the desire to have a gold-backed currency is a wonderful thing. We need it. We really, really need it. We wouldn't have this inflation if we did. Okay, so the big thing, I think the big news in that is that Saudi Arabia is open to selling in other currencies, and they're signing on to the BRICS currency, which could be significant, and that would leave the dollar out in the cold. And so that we could see a significant decline in the value of the dollar, even more so than we have seen. So I know some of you like to travel internationally, as I do, and it's been nice in the last few years because the dollar has been strong. In Europe, the euro was almost on par, and the British pound dropped significantly. So, I went to Portugal, went to Europe, and enjoyed that. So I don't enjoy it when the dollar is down and the euro is $1.40 and the pound is $1.80, and that's not a good fun for me. So, but we'll see what happens in the future with this BRICS currencies. It's going to be very interesting to watch. So now that the U.S., and we're not blind to this, we see this happening. So we see that our reserve currency status is diminishing, and people are talking about it. I'm talking about it. Other people are talking about it. I'm certainly not the first person, but the U.S. is exploring other ways to preserve the dollar's status. Now, one of those ways recently came to fruition just recently, and if you may remember, last March in 2022, Biden signed an executive order looking for and really putting a lot of emphasis on digital assets. So this is what they call the central bank digital currency, and it's already in the works. And in fact, just recently, it's now gone live. So what does this mean? This means that there's a network among all the banks. Your bank is almost certainly on the list. I know mine is. And all these banks are now connected through what will end up being sort of a cryptocurrency system, so they can deal in cryptocurrencies rather than the dollars transactions that we currently do. Now, will this initially be a dollar? Yes, I think that's the way they're going with it. Will it potentially replace the dollar? Yes, I think that's the plan. Will that keep, will we just get rid of our debt? Yeah, I think that's where we're headed. I think we're not ever planning on paying off the debt. I think we're just going to replace our currency with something new. And initially we'll call it a Fed coin or a Fed dollar or whatever it may be. But there'll come a time when the paper dollars that you have, or, at home, or, will no longer be legal tender. They'll no longer be useful. Everything will be digital. And there's good things from that, and there's some bad things from that. One of the bad things is that, well, I guess one of the good things is that there's no real third parties. So, it's kind of like Zelle or PayPal or something like that. You'll have, instantaneous payment, even though those are third parties. This will just be from one bank to the next, or from one payer to the next. And if any of you are familiar with cryptocurrencies, I believe it's, everything is using the Ethereum blockchain. So there are some smart contracts that you can build into that. And then there's also the ability, basically drug dealers and arms sales and all those illegal activities would be able to be traced theoretically. And then I guess some of the negative is that, let's just say the IRS makes a mistake on your tax return and they think you owe a lot more money than you really do, then they can just, reach in and grab that. Or, maybe they've categorized you as a criminal and you're on the run and you don't even know it, and they just turn off all your money and you're traveling somewhere, and then your money is no good. So there's a lot of discussion around that, a lot of ethical issues. And but I don't see it changing. I see this is definitely the way we're going in the future, and it's going to be interesting to see what competitive currencies come into being. Like, for instance, four states, Wyoming, New Hampshire, Nevada, and then one other I can't necessarily remember, but they've started using their own gold currency. So what does that mean? Well, they're taking polymer paper. They're taking a polymer paper, or a plastic polymer, and they're spraying gold in it. And they're taking the gold, and this is exactly what they call a gold back. You can see that, shiny gold. It does contain gold. it's 1/1000th of an ounce. So 1,000 of these would equal 1 ounce of gold. Okay. And this one's Wyoming. I guess that was the other state. So those 4 states are now using this as legal tender in those states. And you know, there's 4 states to do it, and they all kind of look the same, got different images on there. They're pretty durable. I tried this out on my 1-year-old son. He had it for a while, and you can see it's a little bit of wear and tear, but it's still there, still works, still spendable. So that's one thing that you see happening. Another thing that you see happening, and I can all trust you for not snagging this because you're at home, but is these things. This is an ounce of gold that's been perforated, okay, into 1/10 of an ounce pieces. See those? So you can take this and just, like, you know, let's say you don't need to buy the whole cow, you just need to buy a few gallons of milk. Well, you can just take that off of there and peel that off of there. So there's a lot of innovation going on in the world out there, especially in the financial sector, and the precious metals sector, to do things that are alternative. So that's interesting. And of course, we still have the Bitcoins and the Ethereums and all the blockchains that are out there too. So we'll see how far this gets and how far it takes us. And I can tell you that a lot of times when you have a crisis, it's a lot easier to push these things through. And so, you know, if you're trying to create a crisis, then we're doing a good job. We're doing a good job at trying to create one, because we're certainly on the way. So what can happen what are the potential headlines for the rest of the year? Inflation is going to be sticky, possibly and probably. I mean, we had the Inflation Reduction Act and this other act, the CHIPS Act, I believe is what it's called. And so there's roughly $1 trillion of spending there that hasn't even really made it out yet. So, you know, for them to spend a whole bunch of money to fight inflation is completely ridiculous, because it just does the opposite. Recession fears, I think there's already recession fears. We know that from just the news that we can see. Positive earnings surprises, maybe in the military industrial complex, right? But they're the only ones that really are really making any money these days, which is, you know, pretty obvious. So if we look at earnings growth, not a whole lot of positive things to say about earnings growth. Earnings growth is down. It's even negative now. And I think we can expect more of that. I mean, there's certain sectors that are going to do well, and then there are just certain sectors that are not going to do well. One of the worst sectors that we're expecting is commercial office space. I mean, if you look at this office building here, we're probably 70% unoccupied. We went over to the King and Queen building not too long ago, and they're probably about 65%, 2/3 unoccupied. So there's a lot of space that's rented out, and tenants like us are still on the hook for that. We've been using the space consistently, but there's a lot of other businesses that are just still not back, and there's a lot of space that's empty, and a lot of these leases haven't really come full, you know, to mature yet, but they're still starting to mature. And this just isn't in Atlanta. This is all over the country. California, New York, they're even worse off. Georgia and Atlanta's done pretty well, but even now we're looking at, you know, having to renew our lease because they're talking about destroying this building because they can't get anybody to rent. And I don't know, I guess we'll put residential here as the plan. So it's not just in Atlanta, it's all over the place. So that is really the sector to watch, commercial office space. Obviously, residential has cooled down significantly because interest rates are much higher, and it costs triple to get a mortgage. So there's not a whole lot of new mortgages going on there. You're still going to see some cash buyers, but if you're a cash buyer, you're probably better off to wait, because prices will be going down, I do believe strongly. So how long will inflation stick around? Well, it's like I told my class yesterday, prices aren't going down ever. You know, they may go down vis-a-vis a new currency that they come up with, but vis-a-vis the dollar, they're not going down. The dollar was worth $1 in 1917, and today it's worth 2 cents. That's how much purchasing power we've lost. And it just so happens that that's the tenure of the Fed. So the Federal Reserve Bank creates money from nothing. And when they do that, they deflate the value of the currency that's in your pocket that you had to work for, you had to pay taxes on, you had to invest, you had to take a risk on, and then pay taxes on those investments. And in the amount of time that we've been talking here today, they've printed more money than all of us here will ever make in our lifetime. I mean, and that's just the truth of it. I know some of you are multimillionaires. I know you are. And that's just the truth of it. So we have to look at inflation. Inflation scares me because, if I'm planning for someone's retirement and I'm looking at the prices today and they're already bad, especially in the healthcare sector, and I fast forward 20 years, Judy Seeger today doesn't need any long-term health care, but in 20 years, in her 90s, she may. And what's the price going to be there? And am I going to be able to afford to bring care into her home to take care of her there? That's my frustration. That's where we go, because other things, as long as you don't have that long-term care need, then everything sort of works out. You've got major medical, Medicare for heart transplants or whatever you may need. You've got your house burns down, you got insurance for that. You get in a car wreck, you got insurance for that. But if you have that long-term care need, that you've got to pay someone $20 an hour, and that's today. So $20 per hour for home health care. So $240 a day. Okay, so $2,400 every 10 days, roughly $7,800 or whatever a month. I mean, and that's today. So give that 10 years, it'll be double. Another 10 years, it'll be double again. So we'll be looking at like, $80 an hour. That's my concern, but I don't see inflation going away. I don't see prices going lower. We hope that it slows down, and it does seem to be slowing down, but it's really tough, especially for a certain strata of people who are on fixed income, people who are no longer working, and people who are just impoverished. I mean, it's just terrible for them, and they think they're getting all this free money, but it comes at a great cost, and that's that's the trickiness of it, or whatever, the deception there. So where are short-term rates going? Well, they met in July. They're meeting again later this month, between the 19th and the 20th. They're probably going to announce, there's a 93% chance that they will announce that they'll just keep rates where they are. But those are the chances as of today. That could change. So we'll be watching that. If they do raise rates, I don't think it's going to be very much more. I mean, based on what I'm reading, there's an expectation between another 75 basis points to 100 basis points, maybe for next year. But that's if the crash hasn't happened yet, which it could. Someone asked me yesterday, well, when is the crash going to happen? Well, I really wish I knew that exactly. All I know is that, you're either walking through a minefield or you're not. And right now we're walking through a minefield. So I just don't know which one of the things are going to be to set the whole party off. But like I said, it's this office space that we're really watching. That seems to really be where we're hearing, the bad numbers are coming. So if interest rates do go up, and one of the reasons these banks have had a lot of trouble is because all the bonds that they have had and they own, which is the majority of their assets, those have dropped in price. Why? Well, because interest rates have gone up. When interest rates go up, let's just say you have a bond that pays 3%, and now all of a sudden you can get a bond that pays 4%. Well, who wants to buy your bond that pays 3% when they can buy a bond that pays 4%? So the price of your bond has to drop to equate the same yield. So these banks have sort of kind of two categories for all their bonds. One is, marked to market, and one is marked to maturity. So if we have these bonds and they mature, you get all your money back. Okay. If you buy a bond at 100 and it drops down to 80 because interest rates have gone up, but it matures, you get 100. Okay. But if you market to market, then your bonds aren't worth 100, they're worth 80. Okay. If you market to maturity, well, they're not worth 80 what they are currently. They're worth 100 because that's what they will mature at. So those are the big differences with these banks. And a lot of the banks, I guess, were forced to market, which just means their bonds had taken a real drop. So and then of course, if they're lending to these high flyer venture capitalists that are doing internet venture projects, there's going to be some volatility. Over time, this is what everyone says, obviously, is over time, the bull market wins. And it's true, our bull markets go usually much longer than our bear markets, but our bear markets can be pretty steep. I mean, obviously the one in 2008, we saw a 52% drop. So, that's kind of what we're looking at. Again, I showed you those charts about the aggressive hikes then, and then the pause, and then the subsequent drop. And then I'm showing you now there's aggressive hikes that we've had, and there's not yet a pause, but maybe a quasi pause. We'll see. If there's another big drop, then they could pause, and then but we saw then back in 2008 and 9 it recovered a lot, and then it dropped again. So not 7 and 8, excuse me. The other thing, the last thing I want to talk about are these investing fads. I know you guys get all beat up with internet emails about this fad and that fad, and right now the hot topic is AI, artificial intelligence. But I want to let you know this is not the first fad that's come around, and every one of these fads kind of soar and peter out, and it has to do with the hype that's going on. So back in the 70s, early 80s, gold was a big hype. And that went way up 400%, then that dropped back down. Then you remember in the late 80s, it looked like Japan was buying up everything in Atlanta. They owned the IBM Tower, the Equitable Building, if you remember that. I don't know what else they bought up a lot of stuff, and there was this fear that Japan was going to buy up everything. Well, that petered out. Then in the early 90s, it was Asia, and then that sort of petered out. And then we had the big internet boom in the late 90s, and then that really petered out, right? We had a big massive crash after that, and then we had a housing boom because of all those real low interest rates and the 0% ARMs. Remember, 0% ARM or 3-year ARM at 0% or 1%, and then after they started adjusting, well, that was a major crash. Then right about that time, everybody got hot on China, and like, we're going to do a bunch of China's just going crazy, buy a bunch of China, and then that crashed. And then in 2013, the biotech bubble came along. Am I taking you down memory lane? Okay, and then right around 2019, 2020, we had the FANGs, and then what was it? Facebook, Apple, Amazon, Netflix, and Google. Okay, and so those are still in play as we've seen, but obviously Netflix and some others have taken a hit, and we'll just have to see how that goes. I don't even know if Amazon's profitable. I hope they are. I assume they are. I love Amazon. And then right now with 2022, 2023, we're seeing the AI explosion, and we'll see, how much more that goes. I get a lot of information about that every single day. So just be careful about that. You're getting a lot of pump and dump, which means these companies come up with people will come up with companies they just sort of throw them up, and then they pump them out, and you guys buy them, and then they're selling them behind the scenes, and all of a sudden it collapses. That's happened. That happens again and again. So, but what I want everyone to focus in back on then is the big picture. And the big picture is, the cycle that we go through. I call it the super cycle. The cycle that we go through where, we go through a recession, we drop interest rates, we have stimulus, market picks up, we do well, we have inflation, but now we've got to raise rates and we've got to reduce, the stimulus, and then all of a sudden we have a crash, and then we go through it again. And then, it's like a 7 to 12-year cycle. So remember, we're interest rates are higher than they've been, and now in 21 years. So we've had we've had a lot of interest rate activity, and we've had a lot of reversing of the money purchasing. So we're going through a pretty strict monetary contraction, and at the end of that is almost inevitably a recession. So that's where we are today. And I don't mean to bring you any bad news. The good news is if you're a client of ours and we're managing your money, you're 90% out of the stock market, 90% out. We have some money in gold and silver and oil, which we expect will do well when they start printing money again. We'll sell those probably. But we're, for the most part, in treasuries. When we looked around in 2008, we looked around at every single thing out there to see what held up well. Was it the Swiss franc? No. Was it gold, silver? No. Was it U.S. stocks, Australian stocks, Canadian stocks? No. Was it European? Was it Asian? Was it Chinese? Was it anything? No. Was it oil? I mean, was it fine precious metals? Was it rubies, diamonds? I mean, no, it was nothing. Everything collapsed except for one thing, and that's one thing only, and those were U.S. Treasuries. Now, How long will that continue to be the case? I don't know, but I think it's still pretty much the case, because when we see these little mini crashes that we've been having along the way, the treasuries still do rally, and that's what we expect. And when we feel like the Fed has plateaued on their interest rates there, then we're going to go out longer term on our treasuries. They're still liquid, but when interest rates start dropping, these treasuries will really rally once the yield curve becomes non-inverted again. And when that happens, we hope to see a lot of good opportunities in value stocks that pay dividends, household names, Kellogg's, Post, General Mills, Kraft, the things that people all use, Colgate, Palmolive, your toothbrush and those things. So that's where we are. We have a pretty clear vision of what we think is going to happen. Of course, that never works out exactly as you expect, right? So there's always going to be hiccups. But we stay nimble, and we're staying liquid, and we're staying safe. And we hope that you agree with our philosophy. If you do not, please contact me, and we'll make arrangements to do whatever you think is best. But you sort of recruited us to do what's best for you, and we're looking out for you as the best we can. So we're getting about a little over 5%, 5.25% on these T-bills, and we're just going to continue to do that until the Fed pauses, and then we're going to go out longer term, and then we're just going to hold tight. And when the market crashes, we're going to have a lot of dry powder to buy things that look good. Like Warren Buffett says, there's nothing appealing right now to buy. So we have a moratorium on buying equities right now. Any questions from anybody? I see one or two up there that have popped up. Let me just get those real quick here. Okay, so thank you, Judy. You're welcome. She says, thank you for the comforting presentation. Yes, you're welcome. I hope that's comforting, but we definitely are working to keep you guys safe and not caught off guard. I mean, I know you're watching TV, and I know you're hearing this and that, and they're all saying, oh, the market's up, it's doing better than ever. But you've got to ask yourself, when in history have they ever said to sell? They didn't say sell. Here comes Y2K, and here comes maybe these internet stocks that have overbought. They never said to sell. In 2007, when things were just out of control and you had price earnings ratios over 100, they never said to sell, and they're never going to say sell because it's not in their interest for you to sell. It's in their interest for you to hold. And what they do is they sell and they hedge and they sell short and they buy puts and they sell calls and these other things. So, that's why the Kool-Aid is always buy and hold, invest for the long term, those kinds of things. But when the writing is on the wall and you can see these interest rates go up, market crashes, we reverse it. This is how Warren Buffett has made his fortune. Okay. I mean, he basically straight out said it at one conference that I was at. And it was really him that sort of opened my eyes to, wow, there's a whole pattern here. And then I got involved with the Austrian economists, and they have, the statistics and all the data to prove what he's saying is true. So I appreciate all of you joining us. I appreciate you having you as clients. I appreciate you having you as friends and family. And I look forward to seeing you around. And for those of you who are in other states, God bless you. And we hope that everything goes well with you, and enjoy your long-term, your long, Labor Day vacation weekend. So thank you and have a great day. Bye-bye.